If you were holding gold, silver, or Bitcoin over the past 6 months, I need you to sit down for this one, because in a single trading day, gold dropped over 11%. Silver had its worst day since 1980, down more than 30%. Bitcoin fell below $80,000 for the first time in months, and the craziest part? None of it was caused by a war, a hack, or a stock market crash. It was caused by one man getting a phone call from Donald Trump. And if you panic sold anywhere in that window, stick with me, because what happened next might be the most expensive lesson of your investing year. By the end of this video, you're going to understand exactly who Kevin Warsh is and why the market reacted the way it did the moment his name came up, what actually happened at his first meeting as Fed chair in June that sent these assets tumbling again, why this kind of crash happens mechanically, not emotionally, every time the Fed shifts its tone, and whether the safe haven thesis behind gold, silver, and Bitcoin is actually broken, or whether this is just noise on the way to a much bigger move. That last part genuinely surprised me when I dug into the numbers, so don't skip ahead. Let's start with the guy at the center of this. Kevin Warsh isn't some random Trump loyalist plucked out of nowhere. He actually served as a Federal Reserve governor from 2006 to 2011, which means he was in the room during the 2008 financial crisis, helping design the emergency programs that kept credit markets from seizing up completely. But here's the twist. He left the Fed and became one of its loudest critics, arguing for years that the central bank had gotten too comfortable with easy money and lost its discipline. He'd even been a finalist for the job once before, back during Trump's first term in 2017, so this wasn't a total surprise pick either. Trump officially nominated him in late January 2026 to replace Jerome Powell, whose term as chair was ending in May. The confirmation process wasn't smooth. One Republican senator threatened to block the nomination entirely over an unrelated Justice Department investigation into the Fed's building renovations. That investigation got dropped in April, clearing the path, and the Senate confirmed Warsh in May by a 54-45 vote, the most party-line Fed confirmation in history. He was sworn in as the 17th Fed chair on May 22nd. Now here's the part that actually moved markets before he'd chaired a single meeting. Traders had to figure out in real time which version of Kevin Warsh they were getting. Is this the inflation hawk who fought against easy money during the financial crisis and has spent over a decade publicly criticizing the Fed for being too loose? Or is this Trump's guy, installed specifically because Trump has said openly he wants a chair who'll cut rates aggressively? Those two versions of Warsh lead to completely different worlds for gold, silver, and Bitcoin. A hawkish Warsh who keeps rates higher for longer is bad news for all three, because none of them pay interest, and a stronger dollar plus safer treasury yields make them less attractive by comparison. A dovish, Trump-aligned Warsh who cuts aggressively has historically been great for all three. Nobody knew which one they were getting, and that uncertainty alone triggered the first crash. On the day Trump officially announced the pick, the dollar strengthened almost immediately, which traders read as the market approving of Warsh's credibility and independence. But that same strength in the dollar hammered the assets that had been riding a weakening dollar narrative for the past year. Gold, which had roughly doubled over the previous 12 months and had just touched $5,000 an ounce for the first time, dropped over 11% in a single session, settling around $4,700. Silver, which had been on an even wilder run, fell more than 30% in one day, its worst single-day drop since 1980. And Bitcoin slid below $80,000 for the first time since April, eventually trading in the mid-70,000s. The mechanism here is worth understanding, not just the number. When a new Fed pick is seen as credible and independent, bond investors demand less of a risk premium, which pushes real yields up and strengthens the dollar. Gold and silver compete directly with yield-bearing assets like treasuries. When treasuries suddenly look safer and more attractive, money rotates out of metals. Bitcoin, despite being marketed as digital gold, has traded increasingly like a leveraged risk asset over the past few years, so it got caught in the same downdraft, amplified by traders using borrowed money who got forced out of positions as prices fell. Fast forward to June 17th, Warsh's first meeting as chair. The actual rate decision itself was boring. The Fed held steady at 3.5 to 3.75%, exactly what was expected, with futures markets pricing that outcome at 97% going in. But what nobody had priced in was what happened underneath the headline decision. 9 of the 19 Fed officials suddenly penciled in at least one rate hike before the end of the year, pushing the median year-end rate projection up from 3.4 to 3.8%. That's a real philosophical shift from we might cut to we might actually raise. On top of that, Warsh did something no Fed chair had done in 14 years. He declined to submit his own personal projection to the Fed's quarterly dot plot, breaking a tradition that Powell, Yellen, and every chair since 2012 had followed. Traders read that as Warsh signaling he'd rather let incoming data speak for itself than commit to forward guidance the market could bank on in advance. Bitcoin, which had been trading around $66,000 heading into that meeting, slid into the 64 to 65,000 range within hours of his remarks. Here's the simplest way to think about what's actually going on with this Fed. Imagine the Fed as a GPS that everyone's used to trusting for turn-by-turn directions. You know exactly when the next turn is coming because it tells you in advance. Warsh just ripped the screen out of the dashboard. He's telling the market, I'll tell you the turn when I make it, not before. And markets hate that because uncertainty is the one thing traders can't hedge against with a spreadsheet. If you're the person who watched your gold, silver, or Bitcoin position get cut down on either of those 2 days, and you either sold in a panic or just sat there frozen watching the number turn red, that reaction makes complete sense. Nobody's wired to calmly watch 30% evaporate out of a silver position in an afternoon. But understanding the mechanism behind a move like this is what actually separates a good long-term holder from someone who gets shaken out right before the rebound, which is exactly what happened next. A lot of people online chalk this whole thing up to Trump broke the Fed and left it there, but that's not really precise enough to be useful to you as an investor. There are 3 specific mechanisms at play, and once you understand them, you'll actually be able to predict the next move instead of just reacting to it. The first is the opportunity cost of holding a non-yielding asset. Think of gold and Bitcoin like a piece of land that produces no crops. It can still be valuable, but if the bank down the road suddenly starts paying you 8% interest just to park your cash there, that non-producing land needs to be worth a lot more, a lot faster to compete for your money. When Warsh's dot plot suggested higher rates for longer, treasuries effectively became that higher-paying bank, and gold's appeal shrank in comparison. The second is dollar strength, and this one's almost mechanical. Gold and silver are priced globally in dollars. When the dollar gets stronger relative to other currencies, it takes fewer of those stronger dollars to buy the same ounce of gold, so the price in dollar terms drops even if nothing about actual gold supply or demand changed at all. A credible, hawkish-leaning Fed chair strengthens the dollar almost by reputation alone, which is exactly what happened on nomination day. The third is leverage unwinding, and this is the one that explains why the moves were so violent rather than gradual. A huge amount of trading in silver and crypto happens on borrowed money. Traders put down a small deposit to control a much larger position. When prices start falling fast, exchanges force those traders to add more cash or get automatically sold out, which pushes prices down even further and faster than the actual news would justify on its own. That's why silver's move looked less like a correction and more like a cliff. Once the forced selling kicked in, it fed on itself for a few hours until the leveraged positions were cleared out. If this feels familiar, it should. Rewind to 2022 when the Fed under Powell was hiking rates aggressively to fight inflation. Gold slid. Bitcoin cratered from around $69,000 all the way down under $16,000, and plenty of people called it the end of the digital gold thesis entirely. But once the market fully priced in the Fed's hiking cycle and inflation actually started cooling, both assets didn't just recover. Gold went on to roughly double over the following 2 years, and Bitcoin eventually pushed to new all-time highs. The pattern in both cycles is strikingly similar. The crash happens on the uncertainty and the initial hawkish shock, and the recovery happens once the market has fully digested the new reality and starts looking past it, which brings us to just over a week ago. Warsh gave his first international remarks as chair at the ECB's Sintra Forum in Portugal, and his tone noticeably shifted. Asked directly whether he thought the current AI spending boom was inflationary, he said, quote, he wasn't ready to make that judgment yet. Traders read that as meaningfully less hawkish than his June debut, and the reaction was immediate. Precious metals markets added over $1 trillion in value within hours. Gold rallying back toward $4,080, silver up around 6%, and Bitcoin reclaiming the $60,000 level after having slid to its 2026 low near $58,000 just the week before. That's not me telling you. Gold, silver, and Bitcoin are guaranteed to keep climbing from here. The bond market stayed notably skeptical of the rally. The 10-year Treasury yield actually rose to around 4.46% during that same which tells you professional bond traders aren't fully buying the dovish read yet. Warsh himself, even during that softer moment, kept stressing that prices remained too high and gave no hint that a July rate cut was on the table. So this is genuinely a live, unresolved situation between a Warsh who leans hawkish to protect the Fed's credibility and inflation-fighting reputation, and a Warsh who eventually gives Trump the lower rates he was arguably appointed to deliver. The upcoming U.S. jobs report and the next FOMC meeting, roughly 4 weeks out from Warsh's Sintra comments, are going to be the real test of which version of this Fed chair we're actually dealing with. If inflation data comes in hot and Warsh reverts to the hawkish tone from June, expect another leg down in these assets. If jobs data softens and gives him room to sound more dovish again, expect the rally that started in Sintra to have legs. This is exactly the kind of environment where reacting to every single headline will wreck you emotionally and financially. The better approach is understanding the 2 or 3 data points that actually matter and largely ignoring the noise in between. So if there's one thing to walk away with, it's this. The crash wasn't really about gold, silver, or Bitcoin being broken as assets. It was about a single new Fed chair injecting enormous uncertainty into a market that had built an entire year-long rally on the assumption that rates were only heading one direction. Uncertainty gets priced brutally and fast in both directions, which is exactly why you saw double-digit swings on nomination day, another leg down in June, and then a sharp reversal in July, all tied to the words of one guy in one room in Washington and, more recently, in Sintra. If you want to actually track what Warsh does next instead of getting whiplashed by headlines, subscribe, because I'll be breaking down every meeting as it happens, in plain English, without the panic. And if you know someone who panic sold in January or June and is kicking themselves right now, send them this video, not because they need to feel worse about it, but because understanding why it happened is the only way to not do it again next time.